SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith, managing partner of Search Fund Ventures here, and this is the SMB Investor Podcast. Today I'm joined by Bob Wang of T-Up Advisors. And Bob's going to talk to you a bit about how to leverage inorganic growth to really create value for a portfolio company and position it well for an exit into lower middle market PE, which is a prevailing strategy for a lot of folks in this space. So Bob, I'll let you jump in, give an overview of yourself and talk a little bit about T-Up.
Yeah, thanks for the opportunity. My company, T-Up Advisors, our mission is to tee up the next generation. Our area of focus, our desire is to build profitable companies and create generational wealth.
And generally, you focus on that goal by helping business owners leverage inorganic growth, right? To get to that point where they, can reach their financial goals upon exit. Is that a fair way to frame it?
That's our primary way. We help optimize char metrics. We help optimize EBITDA. We help them make the decision between harvest or invest. A lot of entrepreneurs that I work with, they don't have that finance background. They run their business purely on tax law optimization. And at the end, it's got to know value that is on the books, right? You have to sort of play around with the EBITDA to get to, but yeah, M&A is the main driver that then sort of get to their net worth targets within a reasonable amount of time.
Excellent. So what kind of businesses do you typically target? Is there an industry focus, a size range? How does that all look?
Yeah, it's more of a profile in terms of size, between $2 to $50 million revenues. Those are the type of companies that have the resources to make changes. This is a small entrepreneur and they're in the business all day long. They probably don't have even time and energy to think about the next thing. But it's those that are wanting to sell in the next 3 to 5 years. So not in the next year, because if they want to sell in the next year, they should talk to a business broker or a banker. I can't do too much in 1 year, but if they want to really increase their EBITDA, their enterprise value in 3 to 5 years, that's where I can add the most value. So I'll give you some examples. A client that I'm working with, they have a customer concentration issue. So this company is a digital marketing company. They do, I think, $7 million a year, and 60% of revenues come from one group of businesses. And they went through a process and, they went through diligence and it could not be underwritten. So realistically, their business is basically worth nothing. It's unsellable with 60% customer concentration. And it's not like they didn't try putting different programs in place and so on, but when 60% customer calls you pick up, no matter what time of day, you put your best people on it, you put all your effort on it, and by the end of the day, you're too tired to organically grow the non-concentrated part of the business. And they've been doing it for 5 years or so. And I said, look, why don't you guys explore M&A? Because there are going to be other digital marketing companies that are just as concentrated, if not more concentrated, in another customer. They're also worthless or unsellable. You bring them in and both of you dilute your customer concentration. And all of a sudden, you're worth a whole lot more, right? So we did some math. Basically, we went from 0 enterprise value to $12 million of enterprise value through a couple acquisitions. And that's the value that we unlocked, right? But being proactive about M&A and using M&A as a way to solve a business problem and drive more opportunity.
That's a great example. Yeah, we see that in a number of sectors, manufacturing sectors, contract manufacturing, where there's typically a lot of customer concentration or B2G businesses. Those are ripe for this diversification through inorganic growth. Another kind of similar risk, curious to get your take, is key person risk. Acquire into a few more owners or a few more salespeople or a few more operations managers. Now you've got more org chart depth effectively. So
Yeah.
Tell me.
Absolutely. Not to mention skills, geography, offerings, cross sells. Those are all theoretical and need time to realize. The other side is also true, though, Sean, where if you don't have proper guidance and discipline, you can easily get wrapped up in deal fever. Right? You've seen that. I've seen that. I have a client that got a lot of money during COVID, and he went out and bought an engineering company. He's an engineering firm himself. He wants to expand into LA, so he got into he bought a business in LA for 0 money down, all seller note. But there's a reason why you can get those kind of deals, right? Because it's project based, and so he thought he had a good deal. You know, but now that business is not generating a lot of revenue and is still on the hook for the seller note. And he's bleeding like $60,000-$70,000 of cash per month because he's got to pay that note off. I mean, I understand why M&A is such a blind spot. It could be very scary for entrepreneurs, especially if they don't have the experience or guidance, because it is scary. There's a stat that says 80% of deals destroy value. Well, most of that is because people overpay, they don't do enough diligence, and they don't think about integration early enough. And this is where someone like myself, an outsourced CFO, can come in and partner with entrepreneurs to make corp dev a core capability, not just something that they think about once in a while.
Yeah, it's a great, I think, value proposition. There's so many folks that we see on the self-funded search and independent sponsor side where a key pillar of their value creation strategy is inorganic growth. So when you're thinking about what are the makings of a successful inorganic growth strategy, I guess what would kind of be the top 3 things that come to mind?
Yeah, I think if you ask 10 different CFOs, they're going to tell you 10 different things. I would say I have a healthy fear of leverage. So my background, I'm an accountant. I grew my own business. I grew it to 30 people and sold that to Deloitte. That was my first business. And then I was a CFO of a tech company. We grew that to $10 million of ARR. That got acquired by a private equity group who levered up a lot. And then I was in private equity as a principal operating partner. We saw a lot of deals, a lot of LBO models. Leverage just magnifies. It magnifies positive things. It magnifies problems too. So when you're out there as an investor evaluating deals, you're talking to searchers, if they're like, hey, we're going to 90% leverage and staying from beginning to the end of time, you should probably run away from that deal, because one thing goes wrong, the whole thing goes bust. Personally, I would not lever a deal more than 50, 60%, maybe 50% from the bank. I think you can go maybe another 20, 30% from the seller. But honestly, you got to have a healthy fear of debt and leverage, especially in certain times, especially with tariff risks, interest rate risks. Just be really careful. That's one. Another one I would really think about and ask about is who is going to fund you? Searchers, entrepreneurs that I've talked to, they often say, oh, I'll just find the money. I'll go to my bank, or I'll go to this guy. Well, have you talked to them about your idea? Chances are they have a different risk profile or desire. So if they don't have a credible funding source lined up, like a mezz fund, private credit fund, or some sort of private investor that's willing to provide that capital, they're selling a dream, right? And I wouldn't say run, but just dig in a bit more and ask who, tell me who. And if you are an investor that can provide that funding credibly and you like that business plan, it'd be a great opportunity for you to step in for sure.
Yeah, those are great. All these strategies generally, there's a few approaches, right? There's the equitize heavily up front and lever into the deals as you acquire more of them. And that's, ideal from a risk standpoint for a lot of folks, because you can almost increase, like you said, the amplification of good things as you go, but do it in a very deliberate manner. But to your point on your second point, that equity isn't just always available, because now there's a lot of risk that you've over equitized this first deal and it's hard to really build a pipeline. And all of a sudden you're looking at a no leverage return profile. So I think in the ideal world, we're seeing a lot of folks that come in with, 40 to 50% leverage at the acquisition financing, and they structure some sort of, delayed draw term loans, or the SBIC fund provides an accordion so they can kind of expand that facility as they find more deals that fit the criteria. But yeah, the access to capital is huge. There's a searcher we're working with, more of an independent sponsor, who said, the strategy is only constrained by our ability to capitalize it. So that's kind of in line with what you've laid out.
The other message that I would be skeptical about is if the returns can only be hit if you did one acquisition per year for the next 5 years.
Yeah.
Realistically, it's hard enough getting one deal done, but if you must acquire 5 or 6 or 8 in the next 5 years for the returns to work, I would be skeptical.
Yeah, certainly. That's a lot of M&A activity for teams that are relatively small compared to a lower middle market PE firm. That's great feedback on the financial engineering side of things. I guess from an integration or operation standpoint, kind of touching back on your experience as an operating partner and otherwise, what are some things folks should look out for in that value creation plan, or what questions should people ask about, the integration and the post-close inorganic strategy?
Yeah, it's a question. So my plan is typically when I start working with clients is start small, go slow to go fast. Every company is unique. No matter what playbook you follow or read, you got to have your own playbook. And the only way to do that is to buy small. So you can make mistakes. You can digest. If there's a big issue, solve it. You have the energy for it. And you go bigger and bigger and bigger as your playbook and as your team grows. That's number one. If you talk to, they're like, hey, I want to buy another company same size as me the next year. You really have to be skeptical. Like, have you done this before? Because integration is, like I said, one of those afterthoughts. One of the three reasons why 80% of the deals lose value, because you spend so much time doing the deal, you don't think about day one. And what I tell my clients is the outcome of the diligence process. Yes, of course, you want to understand all your risks, but it's also a 100-day plan. Like the outcome of your post-LOI diligence process is a 100-day plan that you can execute. And that is almost never done, especially at the lower middle market, because you're so focused on.
Yeah, it's the folks that are doing that typically have, either consulting at, a McKinsey or a Bain or some private equity focused consulting firm, right? Or operating partner type experience, because it gets so ingrained in, their MO to start planning during diligence. And we love when we see folks actually making steps towards that 100-day plan during diligence, building the backlog with the seller, right? Building the relationships with key people on the team if the seller is comfortable with that, right? So there's lots of things people can do, not only to start crafting that post-close integration plan, but also to actually start effectively de-risking it by executing. But what about multiple arbitrage, right? That's kind of the story around inorganic growth. That's one of the biggest value creation levers. I mean, how, in your experience, how realistic is it to go from a platform that you bought for 4 times, acquire 4 or 5 companies, double or triple, sell it for 8 times? Is that something you see frequently, or is that, kind of unicorn myth?
Yeah, I think it depends on the scale and size. I've seen more of that in my private equity days, where you have a true business fully stacked, like from, you have your C-suite, your managers and so on. And the EBITDA you see on the books is like true EBITDA. And then you buy some other true EBITDA businesses and you end up with another true EBITDA that again fetches higher multiples. And there's a lot of market evidence that's true. I think where it starts to get murky is if you go even lower, you get into 500,000, 1 million, 1.5 million STE as opposed to EBITDA. By the time you pay yourself, you add a few managers, you properly invest in this business, your EBITDA actually hasn't grown because, your STE, let's say, is 1.5 million and your EBITDA now, after all the expenses, is 1.5 million, but you're better resourced. So, and then you do a couple acquisitions there, you're still probably in the range of where you bought because you overbought, overpaid. You paid on the SDE instead of EBITDA. So this is where I think self-funded versus, investor funded, I think that's where some of that, it starts to differ, because for a self-funded searcher, SDE is true income. Whereas in an investment-backed business, you've got to separate between, investor money and your money, right? But yeah, I think, the logic is there. The logic is sound. But I think the key here is to really understand the EBITDA versus SDE.
Yeah, that's absolutely critical. And I think what you were sort of touching on too is that EBITDA is a little bit more baked, right? You've got a platform underpinning the EBITDA, and it's not just a bunch of different companies that are their own operating entities, and any one of them could fluctuate up and down. It's really a holistic unit. And that emphasizes the importance to some degree, curious your perspective, on actually building a platform. So moving all those kind of shared services up top, implementing the software and the back office stuff up top, and having all the acquired entities leverage that rather than each one having their own.
That's why I tell my clients, like, buy small, because actually before we started the M&A process, there's so many things that need to get figured out. Finance, KPIs, dashboards. Like one of the first things that I'm working on right now with a ABA provider who's looking to do some M&A, like the owner is so busy that they literally have no time to do anything else. So step one is to build the management team or build some dashboards so they can manage with numbers instead of through the details. And then she's going to have time for me and for the corp dev function to grow. Not to mention everything we structure, the KPIs and the processes we figure out, that's going to help in absorbing these companies. Right? And by buying small, you can more easily absorb the small company and also refine the process at the same time. If you buy too big, then you're going to have like, hey, we should use this process. Oh, we should use that process. And my process is better. No, our process is better. That's a distraction you do not need.
Yeah, the culture clash, right? That's
Totally.
the classic kind of, ego challenges and mega mergers.
Yeah.
That's great feedback. Well, look, that's pretty much all the topics we had. Any kind of closing remarks you want to make or anything else you want to share about Tee Up?
Here, I think one thing I would add is M&A is very much a blind spot for entrepreneurs because all we know are taking companies from 0 to 1. And if you're a searcher, if you're an investor, if you can help these entrepreneurs open up their minds like, hey, we can be such a value add by just adding a little bit of equity, manage that properly, we can exponentially grow the net worth of all the stakeholders, right? So, that's a blind spot that you can help them overcome. The other thing I would maybe suggest is for searchers to lean in on seller financing a little more. I think we are blessed to have SBA, SBIC funds, and we can go up to 90% leverage. But just because we can doesn't mean we should, especially on a first deal. And I've talked to many searchers that's their plan. 90%, like, here's seller, here's 90% cash up front. Like, okay, give me your business, right? But I'm like, if you want to lose sleep at night, if you want to sleep well at night, you shouldn't do that. You should be more aggressive in asking for seller financing, asking for non-bank sources of funding. So for example, my wife and I bought a business, just she and I. It's a relatively small business. It was 60% seller finance and the rest is our own savings. And we required 0 bank debt. It was the easiest close ever. We sleep well at night. There's nobody hounding us. I need a few extra days to make the payment. I emailed the seller. He's like, yeah, no problem. Okay. I'll pay you on the 5th instead of on the 31st. Just don't be lazy just because you have SBA backing you.
That's great. Yeah. And hopefully in a roll up where, part of that purchase price is coming from cash flow of the business, potentially tapping a bit more your investors' capital. You can leverage a bit more of the seller note rather than needing to continue going back to the SBA. I mean, at a certain point, you cap it out, so you can't even really do it. So it's great.
Exactly.
Well, Bob, it was great chatting with you. Appreciate you coming on, and look forward to hopefully working on some inorganic growth strategies with you.
Thanks, John.
Take it easy.
Yeah.